For the group accounts, which I remember stating some of the adjustment, because we said we got specialized transactions. And the first one I've said that the intercompany balances and owings. So we wrote that one. And then also we wrote on cash in transit, good in transit, errors in the accounts, and realized profit on inventory, that is UPI. We also wrote the adjustment of the UPI against the retained earning and realized profit on the fixed asset. And that, so I think we left at revaluation of non-current asset in the books of, or the depreciation. I think we left at the depreciation, or maybe you can confirm who was there. Caroline, tuliacha wapi? Is it the unrealized profit or the fixed asset between the group members, UPFA? I remember writing the formula here, so we wrote up to that. So maybe we can begin with revaluation of non-current assets in the books of subsidiary on the date of acquisition. That is one of the specialized adjustment. So sijui ilikuwa namba ngapi, but now you can just indicate revaluation of non-current assets. So you can write revaluation on non-current assets in the books of the subsidiary. In the book of the subsidiary on the date of acquisition. So explain that and say revaluation is the difference between the value of an asset. Revaluation is the difference between the value of an asset and its carrying amount, in bracket NBV, and its carrying amount in bracket NPV. So the difference between the two, we can have the revaluation gain or loss. So what are the journal entry for the revaluation gain? What are the journal entry for the revaluation gain on the date of acquisition in the books of the subsidiary? So the journal entry for the revaluation gain, So for revaluation gain, we debit the PPE, credit revaluation reserve, credit revaluation reserve. And then this revaluation, so if you revalue this asset upward or downward, you will affect the depreciation. Automatically the value of depreciation will be affected. So we also need to adjust that depreciation. So you can say revaluation can lead to depreciation under charge, which should be eliminated, on consolidation as follows. So we will debit the retained earning and then credit the PPE. With the depreciation and the charge. The depreciation and the charge. So after that, how do we calculate the depreciation and the charge? How do you calculate the depreciation and the charge? So depreciation and the charge. So it can be undercharge or overcharge. But calculation is the same. So it will be the revaluation gain multiplied by depreciation rate. Depreciation rate. So that was one of the adjustment. Another adjustment is dividend paid by the subsidiary. Dividend paid by the subsidiary. Dividend paid by the subsidiary company. That is another specialized transaction. Dividend paid by the subsidiary company. Dividend paid by the subsidiary company, which were acquired during the financial period. Which were acquired during the financial period. The financial period. So maybe you can write, there's a lot of literature there. You can say, the main concern is on how to account for pre-acquisition dividend. The main concern is on how to account for pre-acquisition dividend. Attributed to the subsidiary. Before acquisition. Attributed to the subsidiary before acquisition. Continuation, say, and the post-acquisition dividend. Another point to say, the pre-acquisition dividend is taken into consideration. The pre-acquisition dividend is taken into consideration. For determining goods on acquisition. For determining goodwill on acquisition, not good. For determining goodwill on acquisition. Another point, say post-acquisition dividend are to be credited. Post-acquisition dividend are to be credited in the group retained earning. Post-acquisition dividend are to be credited in the group retained earning account as income to be credited in the group account, retain earning as income. So having all those adjustments, then now we can look at the format for the consolidated income statement. So unless there is a note which it is not clear on your side, then you can ask for clarification. So let's have the format for the consolidated income statement. Consolidated income statement. Always the income statement is for the year. And let me not assume. So we'll start with the revenue. We start with the revenue. So for revenue, you take for the parent plus for the subsidiary. So I hope up to this point, you know what is a subsidiary. A subsidiary is a company which is owned by the parent company with a share contribution of 50 plus or 50%, more than 50%, more than 50%. So if the parent company is owning less than 50% in any investment, then it is not part of the group. The only account or the group account is the parent company and subsidiary. So subsidiary, but make sure also to know if there is any proportion of the year, we apportion. So we take for that subsidiary, and then we eliminate the intergroup revenue. So say exclude the intercompany sales minus intercompany sales. Intercompany sales, because if you sell to subsidiary, this is the same company, so there is no revenue. So if you get that, you will get the adjustment of that. Then you come to the cost of sales. So also take for the parent plus subsidiary. Whatever you have subtracted here, do the same here. Intercompany sales. What else do we need to subtract here? We need to add the unrealized profit or the UPI. Remember, the UPI is a profit which it is not for the unrealized profit. So you will add unrealized profit here, add the UPI, unrealized profit, add the UPI, add the UPI. So those are the sum of the common one. There's a one in it, but these are the common one. So that one will be able to give you the gross profit. So after that, you add other incomes. So add other incomes. Add other incomes. Add other incomes. So the incomes, it can be the investment income. So you add that, you get the total income. Less expenses. Admin. So you will take for the parent plus subsidiary. PS ni parent and then hii ni subsidiary. Distribution cost also check for the parent plus subsidiary. Finance cost, parent plus subsidiary. We have, so that one will be able to give you the profit before tax if you get the total of this. So we might have the impairment. Yeah, the impairment. So if the impairment is not classified in these classes of expenses, then we can have the impairment of goodwill. Impairment. So we can have the impairment. And then that one will give you the profit before tax. Profit before tax, less tax. So the tax will be the parent plus subsidiary. The parent plus subsidiary. So that you get the profit after tax, part. The profit after tax, then the profit after tax. So that is the hatujamaliza. So andika hapo, maybe we can write on the other side. So after getting the part, we can add the income attributable to the associate or the joint venture. So you say add PAT attributable to, add the profit after tax attributable to, add part attributable to, number one, associate. You know the percentage of associate? Anything below 50%. You can also add the profit for the joint venture. So if you own exactly 50%, that is a joint venture. Then from there, now you determine profit attributable to. So we will have profit, the NCI profit, and we will have the parent profit after tax. So NCI is non-controlling interest. So don't say what your NCI ni nini, tuliandika non-controlling interest. So this is the format if examiner give you a balance sheet approach. So examiner will give you two ways. They can give you a balance sheet approach, or they can give you the income statement approach at the same time the balance sheet approach. So that's why we need to cover the two approaches, so that for benefit of doubt. So if you have your past paper, Antayo, up to now, umesha print your past paper. Tulisema you need to print the past paper so that kwa tunasoma online, kila kitu ni online. So make sure that you print your past paper. So I make the question with the two approach. Then from there, we will do for the balance sheet approach. So check September 2015. September 2015. If you have written this, check September 2015. September 2015. So tumeshapata, that is P limited. P limited. So I think it is there. If you download that for online, you can get for P limited. Steve, umeipata?
Yes.
Okay. So kama umepata, then so if you have it, maybe you can take a screenshot and then share in the group. So we have been told on 1st October 2024, P Limited acquire 80% of the equity share of S Limited in exchange of 2 shares for P Limited for the 3 shares of S Limited on this date. The share of P Limited was trading at 8 shilling each. 8 shilling each. So that is an information for calculating the goodwill. Remember, we have the goodwill on the group account. So that information it helps us to know the structure of the company and also to help us to know how much is the goodwill we can get the goodwill. So maybe with that information, you can have the group structure. You can have the group structure. Well, the first thing is to draw the group structure to help you to know which one is a subsidiary, which one is a joint venture, which one is an associate, which one is an associate. So we have been told you have group structure. So P Limited acquiring S Limited with a percentage of 60%. So anything above 50%, that is subsidiary. On which or on which date? That is 1st October 2020, 2014. 2014. When is our closing period, or when are we closing these books of account? That 1st March 2015, which means our books of account ilianza that 1st March. 1st April 2014. So our financial period is covering, that is that 1st March 2015. So which means we started on 1st April 2014. We acquired this associate on 1st October 2014. So it is not a full year subsidiary. It is not a full year subsidiary. So we acquire on 1st October 2014. So from 1st October to that 1st March 2015, how many months? October, November, December, that is 3 months plus another 3 months. So it is a 6 month. So you can say S is a 6 month subsidiary. S is a 6 month subsidiary. S is a 6 month subsidiary. So which means all the transaction will apportion based on that 6 month. To apportion ayo 6 month. Are we in agreement in the 6 months? So kindly count. 3 months to December. So kindly count, check whether it is 6 months. So now with that structure, we can be able now to get the number of shares they acquire with the first note. So we have been told they acquire 60% of the shares in exchange of 2 shares for P Limited for every 3 shares of S Limited. Now they pay in terms of shares. So can't have, we can't call it. It is not, it is a note, it will help us, but we can just say shares or acquired. So we have been told 2 for every 3, so 2 of every 3 multiply by the total number of shares for that company. How many shares do we have for the company? How many shares do we have for that company? How many shares do we have? How many number of shares do we have? Let's read note number 1. The issue of shares on the acquisition has not yet been recorded by PL Limited as the date of acquisition. Okay, so the total number of shares ni ngapi? The total number of shares ni ngapi? Hakuna mwenye anafanya financial management hapa. Look at the ordinary shares. You have been given ordinary shares. The total value
1 million.
ni 1 million. Umeipata wapi 1 million? Look at the total number of shares. Ni ngapi? The total value, it is 8 million. Sindio? The par value ni ngapi?
Yeah.
1. So this one will give you the number of shares. But the question is, are we acquiring the entire number of shares? We are only acquiring 60%. 60%. We are only acquiring 60%. So 8,000 of 60%. So it will be 48. 48. This one is giving us 48. So subject to 2/3. Multiply by 2, divide by 3. So the total number of shares, our nose is 3,200. This is the number of shares. What is the market price per share? Our MPS. I will have to teach you now the financial management ratios. Our MPS is 8 shilling. So can we get the market value or the total value? Yes. So take the 3,200 multiplied by 8 to give you the total value is 25,600. The total value is 25,600. So P Limited acquire S Limited by issuing the shares. Now, the market price is currently selling at 8, but what is the par value? What is the par value or the market or the original price? The par value is 1 shilling. The market price is 8 shilling. The different, we call it the share premium. The different, we call it the share premium. So the share premium is amount above the par value. So our share premium in this case is 8 minus 1. So our share premium is 7. So you can split these this value. So you will have ordinary shares, which is 32 multiplied by par value to give you 3,200, and then the share premium will be 32 multiplied by 7 give you 22,400. Add the 2 to give you the total value. So that one will be our purchase consideration. So this is our purchase consideration. So purchase consideration. So we are done with that statement. We go to note number 1. Or kuna mtu akona swali kwa hiyo statement? We go to note number 1. Number 1, we have been told that the issue of shares on the acquisition of S Limited are needed be recorded by the P Limited. Okay. And then, so that one, there is no adjust. We'll have to just record that one in that way. Number two, as the date of acquisition, the fair value of S Limited asset were equal to the carrying amount, except for an item of plant, which at a fair value of 2 million in excess of carrying amount. That is the revaluation gain. The plant had a remaining useful life of 5 years at the acquisition date. S Limited has not revalued its asset except that plant. So that one will take you to the note which we stated on the revaluation of the asset. So maybe I can go and read that note. The revaluation of non-current asset in the books of the subsidiary company on the date of acquisition. Revaluation is the difference between the value of an asset and its carrying amount. So we debit the retain the PP account and we credit the revaluation. Also, it will lead to the excess depreciation, which will be eliminated on the consolidation. So we debit the retained earning, we credit the PP account. So in this case, you have to calculate that excess depreciation for you because it will affect the retained earning. The retained earning, at the end of this approach, because we are preparing an income statement, we'll have to adjust the profit down to there. That is the retained earning, which goes to the balance sheet. So calculate that excess depreciation on the revaluation. So we can have that one as a working. So that one was, this work is working one. So let's have working two. We can even have, which side is, let's have the statement there so that we can have working here. So that we don't do all the working and then at the end, we'll have to come back and prepare the statement. Then it's according to the values. So we can have the profit, we adjust. Where there's adjustment, to keep at adjustment, to adjust. So number two, the second adjustment in affect our revenue. So we will have the revaluation. That is number two. So revaluation, have revaluation gain of 2 million. So balance of material, how many zeros? 3 zeros. So we have to, because it is 200. No, it is 2 million, not 200 million. Divide by useful life of 5 years to give you excess depreciation. Divide by 5, giving us 4. This is the depreciation. This is the depreciation, excess depreciation. But was that depreciation there for the entire period? No, it was only there for 6 months. So a portion multiplied by 6 over 12. Multiplied by 6 over 12. So we get that, we get how much? It's like half, so it will be 200. So that is undercharge depreciation. That is undercharge depreciation.